Here's a belief most people carry into retirement without ever questioning it. I worked hard, I saved, I'll finally be in a lower tax bracket. For some people, that's true. For a surprising number of diligent savers, it is completely wrong. And the gap between what they expected to pay and what they actually end up paying can cost them tens of thousands of dollars they never had to lose. Retirement taxes don't move in straight lines. They bend, spike, and compound in ways your working years never prepared you for. The exact same income can produce wildly different tax bills depending on your timing, your account mix, and whether you're filing alone or with a spouse. Today, I'm breaking down 5 retirement tax profiles. Find yours, and you'll know exactly which traps are headed your way and what to do before they arrive. 2 hidden traps that ambush almost every retiree. Before we get into the 5 groups, you need to understand the 2 forces that make retirement taxes behave so differently from anything you've dealt with before. Once you see these clearly, everything else makes sense. The first is the Social Security tax torpedo. When you pull money from a traditional IRA in retirement, you're not just getting taxed on that dollar. That withdrawal can drag your Social Security benefits into taxability. Income that was sitting there untaxed suddenly becomes taxable because your combined income crossed a threshold. And those thresholds have been frozen since the early 1990s, never adjusted for inflation. More middle-income retirees get caught every single year just from normal cost of living increases. For single filers, Social Security starts becoming taxable at $25,000 in combined income, and up to 85% is taxable above $34,000. For married couples, it's $32,000 and $44,000. Inside that torpedo zone, every dollar you pull from a traditional IRA can cause up to 85 cents of Social Security to become taxable, meaning you're effectively being taxed on $1.85. If you're in the 22% bracket, that specific band of dollars carries a marginal rate of 40.7%, not your overall rate, the rate on those specific dollars. That's the torpedo. And it's invisible until you're already in it. The second trap is the Medicare IRMAA cliff. IRMAA is not a bracket, it's a cliff. Cross the income threshold by $1 and your Medicare premiums jump for the entire year. In 2026, that cliff starts at $109,000 for single filers and $218,000 for married couples. Cross that first line and your Part B premium jumps by roughly $974 a year. Add Part D and you're over $1,100, triggered by $1 extra. And if you're a married couple, both spouses pay the surcharge, so that $1 can cost over $2,000 combined. The other thing most people miss, Medicare uses a 2-year look-back. What you earn today sets your premiums in 2 years. By the time the bill shows up, the decision that caused it feels like ancient history. Now you can see the battlefield. Let's talk about who's on it. Group 1, the diligent middle. Group 1 is the largest group by far. Singles with roughly $350,000 to $2 million in investments. Married couples with $550,000 to $2 million. Not ultra-wealthy, just diligent. These are the people who maxed their 401k, stayed consistent, and actually showed up. And because of that, they now have something genuinely valuable: options. They haven't locked in a tax disaster yet, but without a plan, they're drifting toward one. The traditional IRA that served them so well during their working years is quietly growing into a future RMD problem. If they claim Social Security too early and leave that traditional balance untouched, they'll walk straight into the torpedo in their 70s with no room left to move. Their greatest weapon is the gap years, the window between when you stop working and when you claim Social Security. Your income is at its lowest. The torpedo isn't active yet. IRMAA isn't a concern. These are your prime Roth conversion years. Fill the 12% bracket, consider the 22%, and reduce that traditional balance while the cost is still manageable. Delaying Social Security to 70 maximizes this window because every year you wait is another year of low-cost conversion opportunity. That said, it's not right for everyone. If your balance is modest or you need the stability, claiming at full retirement age is completely reasonable. The goal isn't blind delay, it's recognizing the window when you have one and using it. Group 2, the Roth-heavy retiree. Group 2 is the person who listened early. They went heavy on Roth contributions, converted aggressively in their 50s and early 60s, and now most of their wealth sits in tax-free accounts. The torpedo is barely a threat. IRMAA is unlikely. RMDs are small or non-existent. Here's what's interesting about this group. Their challenge isn't taxes, it's permission. They spent decades being disciplined, and now they're sitting on a pile of tax-free money, quietly wondering if it's actually okay to spend it. The answer is yes. For this group, the strategy shifts away from conversion and towards spending and legacy. Under the Secure Act 10-year rule, non-spouse beneficiaries have to drain an inherited Roth within a decade, potentially at high rates. If leaving a clean inheritance matters, thoughtfully spending some of the Roth in your early retirement years can actually be the smarter move. A taxable brokerage account is worth having here too, for capital gains favorable flexibility. Group 2's problem isn't the tax code working against them, it's getting out of their own way and enjoying what they built. Group 3, the pension and traditional IRA double stack. Group 3 is where a lot of people feel genuinely blindsided. This is the retiree with a pension, teachers, government workers, military, plus a substantial traditional IRA or 401k. Two streams of guaranteed ordinary income stacking on top of each other before a single RMD or Social Security dollar has even arrived. Here's a real example. Betty is single, receives $33,600 a year in Social Security, and needs $71,000 a year for her spending. That means she has to pull about $37,400 from her IRA every single year. No flexibility. That's just her budget. At roughly $45,500 of non-Social Security income, a single filer exits the torpedo. Betty's spending needs force her past that number, no matter how she structures things. She's going to live inside the torpedo zone, whether she plans for it or not. So what does she do? She converts. Even when the first few $1,000s of that conversion hit the 40.7% marginal rate. Here's why it still makes sense. Once she pushes through the torpedo zone, the next dollars land at a flat 22%. The short-term pain is real, but her future RMDs shrink. She's not paying that 40.7% rate year after year in her 70s. She may stay below IRMAA thresholds entirely. Her lifetime tax bill falls, even though this year's looks higher. For Group 3, the goal isn't to minimize taxes this year. It's to prevent the income spike in your 70s when the pension, Social Security, and a massive RMD arrive at the same time with nowhere to go. Group 4, married couples planning for the one left behind. Almost every married couple is in Group 4 because almost every married couple will eventually become one person. One spouse will outlive the other, sometimes by a decade or more. And when that happens, the tax situation changes immediately and dramatically. The survivor files single. Brackets shrink by roughly half. IRMAA thresholds cut in half from $218,000 down to $109,000. And here's what makes it particularly harsh. RMDs don't decrease. The surviving spouse typically inherits the deceased's IRA and is now responsible for both RMDs as a single filer. Income stays roughly the same. Taxes go up. This is the widow's penalty, and it blindsides couples precisely because it's invisible until it's already happening. The strategy is straightforward, even if the execution takes discipline. Convert aggressively while both spouses are alive. Married filing jointly is the most favorable filing status in the tax code. Use it while you have it. Wide brackets, high IRMAA thresholds, 2 lives of conversion runway. These advantages vanish the moment one spouse is gone. Converting $50,000 to $100,000 a year between ages 66 and 70 can dramatically reduce the burden the survivor faces later. The higher earner should also seriously consider delaying Social Security to 70 because the surviving spouse keeps the larger of the 2 checks, and maximizing that benefit is one of the most durable financial gifts one partner can leave the other. This isn't morbid planning, It's the most loving financial decision many couples will ever make together. Group 5, the high-income retiree. Group 5 is the retiree for whom the torpedo isn't a risk. It's already baked in. Traditional balances of $2 million or more, pensions, investment income, RMDs that don't just push into higher brackets, they push into higher IRMAA thresholds. 85% of Social Security is already taxable. The question for this group isn't how to avoid the traps, it's how to minimize the total damage. The key shift here, since crossing IRMAA thresholds is likely unavoidable, the move is to fill the bracket fully rather than stopping just over the line. If you're paying the surcharge anyway, do more conversions and get your money's worth from that tax cost. Half measures often backfire. You pay the IRMAA premium while leaving conversion value on the table. Qualified charitable distributions are also a powerful tool. In 2026, you can donate up to $105,000 directly from your IRA to a qualifying charity, tax-free, and it counts toward your RMD, lowering your taxable income and potentially dropping you into a lower IRMAA threshold. For people who are planning to give anyway, it's one of the cleanest moves available. Legacy planning also becomes central for this group. Beneficiary designations, trusts, step-up and basis strategies, these aren't optional conversations anymore. They're the core of the plan. Here's the one thread that connects all 5 groups. What matters in retirement isn't your average tax rate, it's your marginal rate, the rate on your next dollar, your next conversion, your next RMD. That's the number driving every smart decision in this phase of life. And once you know which group you're in, the complexity collapses into something you can actually work with. The torpedo, the IRMAA cliff, the widow's penalty, none of these are inevitable. They're predictable. And predictable problems have solutions, as long as you find them before they find you. And if you want to learn more about retiring, watch this video.